This video is about which policies the UK government can use from How the Economy Works, which is Unit 2 of the OCR Economics GCSE. One of the policies that the UK government can use is the Fiscal Policy, which uses taxation and government spending to achieve government objectives. Now there's three states that the budget can be in. The balanced budget, where government spending is equal to tax revenue, budget deficit, where government spending is greater than tax revenue, or a budget surplus, where government spending is less than tax revenue. Government spending is the money that the government spends, how obvious, on all different sectors such as health, education, defence, that sort of thing, whilst tax revenue is all the money that the government gets in from tax, so from all the different types of tax like income tax, VAT, all of them really. And the fiscal policy can be used to affect particular markets in the economy, as the government may deliberately budget a surplus or a deficit to affect the economy, as we're going to see on the next slide. The fiscal policy can be used in two ways: to reflate or to deflate the economy. Reflating the economy has the main names of economic growth and more employment, and does this by using a budget deficit. A budget deficit means that the government spends more and taxes less. If it's spending more on itself, such as in hospitals, it provides more jobs, which leads to a multiplier effect, is when more people have more money because they've got a job, then they spend more, which leads to increased demand, which leads to the need for increased supply, so other firms employ more. So that leads to increased employment and economic growth because there's an increase in output due to the increased demand and thus the increased supply. The reduced tax increases the disposable income, so people spend more, and consumer expenditure rises, which continues the multiplier effect, providing more employment and leading to economic growth. The fiscal policy can also be used to deflate the economy, which is used to reduce inflation and reduce the balance of payments deficit by means of a budget surplus, so the government spending less and taxing more. It spends less itself, such as on benefits, which reduces the income for others, so they have a lower disposable income, which leads to a negative multiplier effect, so reduced total demand, because people can't spend as much because they haven't got as much. If they're not spending as much, then they're not demanding as much, and if they're not demanding as much, there's not the great need for supply, so the need for supply decreases, so firms say, sorry, you're unemployed now, we don't need you because we're supplying enough as it is. The government also increases tax, which decreases people's disposable income, so people spend less, and consumer expenditure falls, which continues the multiplier effect, leading to reduced inflation because firms either lower prices to try to increase the demand a bit, or keep prices at the same level because people simply cannot afford to buy expensive goods. And it also reduces the balance of payments deficit because people haven't got as much disposable income, so they're not spending much on products from abroad, hence the total import is decreasing. Unfortunately, there are many drawbacks of the fiscal policy. One is that the government doesn't actually know how effective the policy might be. People might not actually respond to the changes in tax, although they usually do, hence the fiscal policy is used short term. There's also the issue with the changing disposable incomes. For example, workers may push for a wage rise if their disposable income falls, which would be inflationary. They'll push for the wage rise because they've not got as much disposable income, therefore they can't afford more. So they want to be able to buy the same products they could buy before, so they'll be like, oh, we want more money, so they'll try to get a wage rise. But if disposable income increases, workers might actually save rather than spend, so it's not actually helping to form a multiplier effect and increase employment and economic growth and stuff. There's also the issue of time lags. So these policies actually take quite a while to put into effect, and by the time they're into effect, the situation in the government might have actually completely changed. And there's also the issue that using one policy could be negative for another policy, hence a careful balance must be maintained. For example, if the government wants to increase employment and reduce inflation, it's got the issue, does it try to reflate or deflate the economy? I don't know. It doesn't know either, it has to make a decision, and it's got to choose which one it wants the most. Moving on now to the lovely topic of money. Money has got four main functions. It acts as a medium of exchange, a unit of account, a means of deferred payment, or a store of value, i.e. mums, M-U-M-S. How cool. Okay, a medium of exchange is when you can exchange the money for a product. Because the money is trusted, people will be prepared to accept it in exchange for their item, and then these people will go and use this money to go buy more items. It can be used as a unit of account because products can be given a monetary value because all money is worth the same amount because we trust it. So we can say, oh, this printer is £5, this camera is £20. Very unrealistic prices, but it means that people can make comparisons easily. It can be used as a means of deferred payment, so a time and value in the future can be decided for the money to be exchanged. Like, you can use cheques to do this. And you can promise to make payments in the future, like interest rate payments, something like that. And money is also a store of value. It will retain its original value. This is quite a shifty one because there's also the issue of inflation, meaning that money won't actually retain its original value. So £10 today might not be £10 in a year's time. So we've got to be very careful there. Now, banks and building society deposits are considered to be invisible money because they're only seen as figures on paper, but they can be used for all the normal functions of money. It's quite hard to define what an interest rate is, but the generally accepted definition is that interest rates are a reward for saving and a cost of borrowing money. Interest rates vary from place to place, and even within a place it will vary more, as we'll see later. But in general, interest rates on saving are lower than on borrowing because banks charge money when lending to pay costs and to make a profit. So they take more money in from the money they let out to borrow, so they get more money from the interest from that than they have to pay out to the people that are saving their money. There's often competition between banks and building societies, so it's just useful to know what a bank and a building society is. A bank is owned by shareholders, whilst a building society is owned by the people that save and borrow with them, and building societies often have higher interest rates. Within a bank or building society, interest rates increase the longer the money is in the account, when the saver is committed to a saving plan, and when the saver is committed to another account within the bank or building society. Firms that are trusted by a bank and often use the account and always pay it back can gain a lower interest rate on loans than a new business because loaning money to a new business is risky because the bank doesn't know how successful the new business will be and whether it will actually be able to pay it back. The greater the security offered by the borrower, the lower the interest rate. This is why house mortgages are low, because if someone fails to pay their mortgage, the bank can just repossess the house, which isn't pleasant, but it means that the bank has got a backdrop, or whatever it's called. And borrowers with little security are often refused by banks and can be exploited by loan sharks, who offer sort of monthly loans with ridiculously high interest rates that the borrowers have no hope of paying back. And so they end up in a horrible debt spiral where they owe more and more money to the loan sharks, who agree to make more loans so they can pay the money back, and you end up in massive debts. Loan sharks are never the way to go. We now move on to the monetary and interest rate policy. The monetary policy is a policy aimed at affecting total supply of money in the economy, whilst the interest rate policy uses interest rates to achieve the government's economic objectives. When you're in an exam, you can just combine these and put monetary brackets interest rate policy, and that'll be accepted as being just fine. The people that deal with the monetary interest rate policy are the Monetary Policy Committee, or the MPC. The main objective of the interest rate policy is low and stable inflation, and the UK sets a target of about 2% inflation per annum, which is measured by CPI, as is shown in the previous video, and the MPC, which is sort of run by the Bank of England, set interest rates in order to achieve these targets, as will be explained on the next slide. The MPC meets once a month to set a base rate, which will affect all other interest rates in the economy, but they also have to consider other aspects in the economy while setting interest rates, such as employment, and economic growth, and that sort of thing. So how does the interest rate policy actually work? Well, if the MPC believes that inflation is likely to rise, it will raise interest rates, which reduces demand, because people have less disposable income, and thus spending in the economy, because saving is more rewarding for consumers, borrowing is more expensive for consumers, borrowing is more expensive for firms, and mortgage interest payments may rise, reducing disposable income, unless you're on fixed mortgage rate-like payments. Let me give you an example. Take Cara. Cara is the boss of a big company, but she's also got her own personal life. So, Cara's just been given £1,000 by her mum. She could either spend it or save it. Because interest rates are quite high at the moment, because the MPC has made them higher, she's more likely to save it because it's more rewarding. So this reduces inflation, because if she was spending it, it would increase demand, which often leads to an increase in price. Say Cara wants to buy her husband, Rob, a birthday present. If she spent loads of money and bought him a new Ferrari, she'd have to borrow. But because the interest rates are higher, borrowing is actually very expensive. So Cara spends less and buys Rob a more cheap box of chocolates. Cara's firm wants to buy some new capital, but because borrowing's really expensive with a high interest rate, it doesn't buy the new capital, which reduces demand for capital goods and thus reduces the inflation in that area. Cara also lives in a nice house and she has to pay a mortgage every month, but it's not a fixed mortgage rate. So, when the government's increasing the interest rates, she has to pay more each month in mortgage, so she's got less disposable income left over to buy stuff. So she buys less, thus demands less, so it's a fall in total or aggregate demand, which leads to less inflation, because firms aren't going to put up their prices because people just aren't demanding their products. Supply-side policies are some of the easiest policies to understand and explain, and they increase the ability of the economy to supply more goods and services. So when total demand in the economy is equal to total supply, there's equilibrium output, so the price stays sort of steady rate. But if total demand increases but supply can't increase, the price level will rise, which is inflationary. So we have to increase the supply to reduce this excess demand, which will lower the price. Supply-side policies are effective when demand rises in the economy because it'll lead to greater GDP without inflation. Yay! So what are the supply-side policies? There's education and training, reducing direct taxes, reducing benefits, encouraging enterprise, encouraging new technology and innovation, and reducing monopoly power. It's quite easy to learn these because it's ERR, if that makes any sense, if you sort of read down the left. Anyway, education and training. Because a well-educated and trained workforce is more productive, because each worker can produce more in the same amount of time, which increases total supply, and that's really good, because if we're supplying more, we're matching demand. And how the UK government's doing this, it provides education for all young people up to a certain age, and it's supplying a few bursaries and stuff for university, and offering training in certain jobs. It also reduces direct taxes, because a cut in income tax or national insurance contributions increases the incentive to work, because workers don't lose as much of their income in taxes. And also the government's reduced corporation taxes a bit, because when there's high corporation taxes, firms aren't as likely to invest in better machinery or more workers. So if we cut corporation tax, the firms have more to spend on other things, so we increase employment, increase productivity, increase output and all that sort of stuff. Then there's also reducing benefits, because people may lose the incentive to work if they can receive a similar net income from benefits as from working. So if we reduce benefits, take Sally. Sally used to live on benefits getting £100 a week, now she only gets £50 a week, but she could go get a job at the supermarket for £100 a week. She'll go to the supermarket, go work there, hopefully. The government also tries to encourage enterprise, so new businesses can benefit from tax allowances which cut their bills, so they get capital allowance for investment and they get tax relief, because new businesses are a really important part of our future output and employment. Because say a new business came and plonked down in your village, it could provide jobs for the unemployed people in the area, which would lead to a positive multiplier effect, which is just really good for the area. The government also tries to encourage new technology and innovation by introducing a number of capital allowance schemes to encourage investment. So it provides money or cuts tax on money that firms can spend on capital, such as better machinery, which increases the productive capacity of the economy. Doesn't that sound posh? And the government also reduces monopoly power, because monopolies restrict output and increase prices, as we learnt in Unit 1, and reducing monopoly power can help increase total supply in the economy. And the government also prevents mergers that would lead to greater monopoly power. If you don't remember any of this stuff, just go back to Unit 1 and it'll all make more sense. Unfortunately, there's quite a few negatives of the supply-side policy, such as the time lags, because they take a really long time to put into effect, so they tend to be a long-term sort of solution. They can also face resistance from some groups within the economy. For example, groups of people that are on benefits might not like it that their benefits are being cut, or that money is being spent on firms rather than on increasing the local children's playground, or something like that. And they may also not have the desired effect. Say people didn't actually increase their productivity due to training and stuff. So they might not actually work, but they do usually work. I'd say that this table is probably one of the most important things in this whole video, because if you learn it, you'll know exactly what to write to answer any question where it says, what can you do to whatever objective. So for reducing unemployment, you have a budget deficit and you reduce interest rates. For an economic growth, you have a budget deficit and reduce interest rates. To reduce inflation, you have a budget surplus and raise interest rates. To reduce balance of payments deficit, you have a budget surplus and raise interest rates. You have policies to increase output to help all of these objectives. There could be a problem with a trade-off when two differently coloured, in this table, objectives need working on. The government has to set priorities, and the current priority is to reduce inflation with the hope of this leading to increased employment and growth in the future. And that's the end of Unit 2 Part 3, and therefore all of Unit 2 altogether. So if you haven't seen the other videos, go check them out. They're the same sort of style as this, and hopefully they'll help you with your economics revision. Yay!